Should I elect full SBP or not?
The quote worst case scenario here, financially speaking, is that you live a long life.
Every dollar we pay into this, it goes into a government system and it disappears. We can't access it. We can't ever get it back.
You have a $2.5 million Rolls Royce engine that's giving you this 100% VA disability tax-free for life. When we're talking about SBP, we're inherently talking about...
Good morning to you, brother. Afternoon where I am.
Good morning. Yeah.
It seems like it's been a few weeks since I've been on. A lot of stuff happening. But yeah, here we are.
Busy boy.
What's that?
I said you're a busy boy.
Yeah, I've been busy. Yeah, a lot of stuff happening in the world right now. We're in the middle of this Iran attack, and the markets are nuts. Everything's crazy. But that actually is a good point for what we're going to talk about today, because what we're talking about today is going to be survivor benefit plan for the military. I had a couple questions on it just in the last couple weeks, and sort of did a really deep dive into it to talk about what the best options are. And there's really not a clear-cut case for everybody, but sometimes it makes sense, sometimes it doesn't make sense. It depends on where you've positioned yourself, up to this point in your career, how old you are, and what your outlook is as far as survivor-related death. I mean, excuse me, as far as service-related death.
Yeah, it's a good topic, because it's something that anyone who gets through the 20 years and gets the pension is going to be thinking about. I obviously myself did not make it to 20, and so it's not something I personally dealt with, though. When I was on that ship in Virginia, I did a few analysis for guys of, does it make sense for me? And I have limited knowledge. I know what it is. I've done an analysis where I ran through the timeline of the numbers. At what point does it make sense? If you die in this period, here's the value. And then here's the point where it becomes a net negative if you live this long as the individual with the pension. So it's kind of turning this pension into an annuity effectively. And then we have a lot of comparisons to life insurance. And I'd say most of our clients and audience probably tends towards, I'd rather accomplish the same goals using properly structured whole life. But there's a lot of folks that just want to see, in a vacuum, does this make sense for me to do this SBP? Because it's a decision you're going to have to make. And if you're not well read on it, you might make a suboptimal decision. So Brian's been studying it a lot more, and being in a position where you will have a pension one day, you're going to have to make this decision. And is it worth it for you? And so we'll talk through that and let Brian kind of kick off some of what he's been studying for it.
Yeah, and so for anybody listening, this completely scales. I mean, if you're an enlisted retiring member, you're an E7, or all the way up to 06, 07, it doesn't matter. The numbers will scale based on your inputs. So what I ran here, and the reason I say that is I don't want to scare somebody away who's a different rank, higher rank, lower rank. I just use the numbers that I'm going to be looking at as a looming retirement here relatively soon at the 05 level. So I ran those numbers because I wanted to. Really, what this came down to is I was doing a self study, as well as preparing something to talk about and be able to talk to other people about this. So this is a personal analysis as much as it is, which I could talk about my personal numbers and why I'm going to choose what I'm going to choose as well. But yeah, it's going to be based on, for Air Force, Lieutenant Colonel, for 05 retirement for military. But don't run away if you're retiring at a different rank or different number year structure. The numbers just move comparatively. Yeah. So just starting off, like, when you look at that, I know like you said, you didn't get to 20 years. What did you do? 14, Hans?
Yeah, about 14 and a half. So I separated, but I never had the option for the pension. I was in the class I was in that time period where I had the option to switch to the blended retirement system. And at the time I said, well, I'm a shoo-in for 20. I'm definitely going to make 20. I've got a great career. So of course I'm not going to opt in for a lesser pension where you go from 50% to 40% on the pension side in order to, with hindsight, I should have done the blended retirement, because who I did not foresee the events of the last 5 years totally derailing that retirement. I would be a few years away from that 20-year mark now. But yeah, so I did not, this was never in the cards for me to have this decision point. But let's hit what, what your
And really
background is with the military.
that's even another
And
change. You know, that's it's funny you threw that kink in there because I didn't think about the blended, and I was, you know, my because I didn't take it. I was far long enough in my career made no sense. So on the 40% basis for the base pay, that changes the metrics even more. And you really should analyze this even more deeply. We're just going to stick with what we've kind of prepared. But yeah, if you're in the blended retirement system and planning to retire, you're going to have a lower base pension, which means a lower survivor benefit plan. So it's even a bigger impact considering you're making the same money throughout your career. So for those folks, if you're young, especially, or you know, you're let's say at the 10-year mark where most people are making that decision, like should I stay or should I go? Um, you might want to start thinking right now, if you're choosing to stay, about starting a whole life plan so that you're ahead of the game. And I'll show you why that's important with numbers here. But what it
and
really comes
and
down
I
to
think
is,
that
oh, go ahead.
a lot of our clients are at the I'm retiring soon. I'd say so many of our clients are within a year or post retirement by 1 year, in that ballpark. And those people are almost going to all be the old legacy retirement system where it's 20 or nothing, you get 50%. I say now, I don't know when the cutoff was. I was in the window where you could choose. I think you were too. But at a certain point in the last couple of years, anyone joining didn't have a choice. You're going to be in the
Right.
blended retirement system. And so I'm guessing here, but I would say that anyone who's in the I was forced to do the blended retirement system has at least 15, maybe 12 years until retirement anyways. And I think that if that's your situation, you can put yourself in a situation to where you don't really need to worry about this because you can optimize so much better. We're talking about the decision point of you're at 20, you're starting, you know, if you're going to make a comparison to a whole life policy, how can you achieve the same goals possibly more optimally with a whole life
Yeah.
policy? Well, you're 12, you got a 12-year jump on this. You can certainly do it. It's not even going to be a hard decision for you. And so think about that, understand what the SBP is, understand the decision you will be making in the future, but also know that if you start right now and give yourself the head start with the whole life option, it'll be a no-brainer down the road.
All right. So yeah, that's absolutely true. And actually the first case we'll look at is a 42-year-old, 05, 20 years in service, starting whole life now. And what that metric looks like. So it's perfect for those people that are at the end too. But so the really you know, the question that everybody faces whenever they get to this is should I elect full SBP or not? And most people only look at that as a metric of full SBP. They don't even analyze should I do a partial survivor benefit plan. But most people, what do you think they do? They get handed this paperwork at retirement at their 20-year mark or when they're ready to walk, and they go, "Do you want survivor benefit plan?" Typically, it's somebody in the financial realm or whatever you guys call it in the Navy. For us, it's like MPF, and they just give you this choice, yes or no, even though
Mm-hmm.
there's a big gray area between. So most
Yeah.
people in the hurry haven't really studied it. They default to yes. It's yeah. I want to make sure my wife's taken care of.
Yeah.
And I respect that, but it's not always necessarily the best thing. And it's not a scam. Like what SBP is, before we jump into it, is just like an annuity that has no asset value. So you're going to pay a certain premium for 30 years or till age 72, whichever one comes later. Should you die before your spouse, she's going to get a percentage of your base retirement pay for the rest of her
Mm-hmm.
life. And then it ends. So there's nothing left over. So we'll talk about some problems with that too, but it's absolutely not a scam. It's just not the only option. So let's look at like how it works. If you choose the yes, you say I'm going to get 100% of retirement pay. It's a 6.5% charge for 30 years or till 70, like a 72. I'm sorry, I said 72 because I'm putting 30 and 42 together for that 20-year retiring officer. It's 70 years old. So let me make that correction right now. 30 years or age 70, whichever is longer.
Mm-hmm. And when you're saying 6.5%, you said earlier you pay a fee to have to opt into this option where if you die, the pay continues or a portion of the pay continues for your spouse after you pass. But when you say fee, really it's basically just, do you
Say
want your
premium.
full pension or do you want a reduced pension effectively? The net
Well,
the net
that's a
effect is.
premium. So if you look at your entire pension, for easy numbers, say it's $10,000. I don't think many people get that amount unless they're like a general officer. So let's just say it's $10,000. They're going to take 6.5% of that every month as premium for the survivor benefit plan. And that's just a graduated number. If you elect 100% of your retirement pay as the base amount that they're going to take the premium off of. So in exchange for that, your spouse will get 55% of your base pay. So using those easy numbers again, if it was $10,000, he or she is going to receive $5,500 a month once you die, if you die first. And you're going to pay $650 a month for that for 30 years or until age 70, whatever comes first. Make sense?
Yep. Yep. Yep.
All
So
right. So
$650. My options are either just to A or B, simple options. I can collect 10,000, and again, like you said, we're going to use 10,000 because it's easy math. It's easy to remember, higher than most people are going to get. But option A, I choose to opt out of SBP, and I get 10,000 a month as my pension, and when I die, that pension dies with me. Or option B, I get my 10,000, I pay $650 a month. If I die in this time frame, then my wife gets $5,500 ongoing as
until
long
she
as she
dies.
lives, until she
Yes.
dies. Okay. So those
Correct.
are our two options.
So to actually put some numbers on this, crazy computer. So for me, like this is just an approximate number. This was going to range because everybody knows that's in the military when you retire, like it's going to be based on the average three. So it depends on what your pay grade was during if you pinned on early, if you pinned on late, if you maxed the scale out. So I just picked approximately $5,500 a month for an '05 retirement. It's not perfect, but that would make my retirement, if that were the exact number, $66,000 a year. If I elect the full 100% survivor benefit plan, I'm going to pay 6.5% a month on that, which comes out to 357 and 50 cents per month, which is what's that? $4,290 a year I'd be paying. And if I have to pay that
And
for 30 years, the total cost is 128,000 what was it? 700. All right, so the benefit upon my death, if my wife dies or if I die before my wife, she's going to receive 55% of this $5,500 a month. So she's going to then receive $3,025 per month, which comes out to $36,300 per year. All right. So we're going to use those numbers throughout this entire talk. So,
let me just make one clarification here, just
yeah,
because the number happens to be the same, that 5,500. In the example we gave of, the first example was this general or whoever has this huge pension they're making 10,000, and we said that 55% of that is what would go to the spouse. That number was $5,500 once that pensionee dies. It happens to be in this case that the number we're using for Brian's initial starting point is also 5,500. I just
yeah,
want to remove any confusion, because if you hear the number 55 in that first example, that is what the spouse gets after the 10,000 pensioner dies. In this case, scratch that. We're scrubbing that. 55 is our starting number that Brian's getting as the retiree here, and the reduced number of 55% is based off of the starting point of 55, and that is the 3,000 a month that Brian's highlighting here, just to remove any confusion, since those numbers happen to be the same.
yeah. Good call. And that was pure coincidence. It's funny how that worked out. Yeah. So, but on the face of that, like on the surface, it seems somewhat reasonable. She gets a guaranteed government income, and what's not to like about that, right? So I'm guaranteeing some income for her for the rest of her life. But there's some problems. Like, what do you see considering that was $128,000 and $128,700 paid if I live the entire 30 years and continue to pay into that? Any
Right. There's a
problems you
break
see with
even
that, right?
point.
Like the downsides?
Yeah, there's obviously a break even point. If you live, like, the longer you live and the more you pay into this without any kind of continued benefit for her, obviously this becomes, at a certain point, becomes a sunk cost. You could outlive that entirely, and now you've just paid that amount of money. So there is the extreme. I mean, that's a problem, is the quote worst case scenario here, financially speaking, is that you live a long life, right?
Yeah,
And
we
that's the
both live
best.
into our 90s. Yeah.
Right. That's the best case scenario. We want you guys to both live that long. And so the best case scenario is that you spend 128,000. This becomes a sunk cost that gets you no benefit for your wife once you live past 70. So there is that initial bad scenario where you don't die. And even right there, the misaligned incentives here, it's like, you know, if this is worth it, you need to die early at a certain point where those like obviously it's kind of like your insurance. You make your first premium payment and you die the next day. Well, from a numerical rate of return, the best case scenario is that you die the day after you pay your first premium, because that is the largest return on what you put in. Same thing here. You make this first payment of a couple $100 and then you die the next day. Well, that's the best financial outcome as far as your wife is concerned in a vacuum of her specific situation. Obviously, we don't want that there. We don't want that to be the case. We want this to be a sunk cost, just like a term policy. Nobody wants a claim on their term policy because that means you died earlier. You want to outlive it. But again, we're talking about insurance and protecting against a risk here.
Yeah. And so I'd say, like, in comparison to whole life insurance, just like term, since you brought that up, we're renting this annuity, if you'll think of it that way. So
Mm-hmm.
compared to whole life insurance, there's no cash value buildup. So I'm paying that from 42 to 52 to 62. I have a need for finance in my life, but I'm getting nothing out of that. So
Right.
right off the bat, when I look at whole life insurance, I'm building cash value. Now, to have whole life insurance that's going to work for this, it's much higher premium than the cost of the survivor benefit plan. And that's a factor in this decision matrix as well. But every dollar we pay into this, it goes into a government system and it disappears. And you know how we both feel about that. We can't borrow on it. We can't access it. We can't ever get it back. Pure
Yeah.
insurance. So there's no
The
asset
com-
value here.
yeah. The conversation to me sounds kind of like when we talk about waiver of premium rider. That might be a little bit more analogous, where we say, hey, a couple $100 a year, if you get disabled and can't earn income, the company pays your premium. We're talking about pure insurance. And so when we're looking at the other elements of our policy structure, and for those IBC clients, this will make sense. The base premium, generates a scaling cash value over time. The PUA premium generates a flat, almost one for one cash value over time. The dividend is an exact one for one cash value over time, right? And so each of these elements of your premium have a benefit, but this one, waiver of premium, we describe as insurance on your insurance. It doesn't provide you it's a sunk cost if it's not used, but it is there in case something bad happens. It's the same kind of discussion here. Hopefully this becomes a sunk cost, but if you need it, it does provide that element of protection. So then the question becomes, can we match that outcome in a more efficient way? And that's where we get into a more in-depth comparison.
Right. The second problem I see with it is, what happens if your spouse dies first? So we
Mm-hmm.
also, when you're making this decision, you also have to consider, is she healthy? Does she have a whole bunch of health issues and is unlikely to live you, or he, for the woman retiree? But if they die before you, you get nothing. The earlier they die, the less sunk cost you had, which is not a great outcome. But let's say they die 30 years into you paying this. I would have paid the entire 128,700, gone forever.
Mm-hmm.
There's no refund on that.
Right.
It's a use it or lose it aspect of the survivor benefit plan. And that's like truly a risk. You're just paying money out and then she dies, like, oops, government got your money.
Yeah.
So
Yeah.
yeah, so there's a big cost there. I mean,
And
the
the other third cost I'd say is, or sorry, go ahead, Reeve.
oh yeah, go ahead, man.
Our third cost there is going to be opportunity costs. And this is really where the conversation is going to have to get down on paper and technical, looking into the weeds, because
Yeah.
the opportunity cost of paying this, is going to go, we're going to say, all right, well, we could be paying a couple $100 a month towards survivor benefit plan for this protection. What else could we do with that money? But in order
Yep.
to do something else with that money, we have to also bake into it that there's going to be a cost of insurance here. But then those costs of insurance if we do it with whole life, generates value that we can then use and leverage, for instance. And so it's not as simple as, the knee jerk conversation, like you talk to your Dave Ramsey's, like that kind of mentality, and that the type of financial strategy we always hammer. The knee jerk reaction is going to be, oh, don't do that. Put those $300 into an index fund or a mutual fund at 12%, and you'll way outperform any benefit you're going to get from her outliving you and then getting this $3,000 a month or whatever that 55% number is that she would get continuing on after you die. And it's always going to come down to, well, what if you just invested this money instead in the money in mutual funds? Well, that's not the kind of conversation that you should be having. Like if that's the level of analysis you're doing in should I be putting money in the survivor benefit plan or not, that's not the right answer, because you need to compensate for an apples to apples. You need to have a protection element that you're replacing the protection that you're losing here. And so that's where the life insurance death benefit comes in. And so can we adequately replace the protection while providing some value? And then from there, can we leverage that? So the opportunity cost is going to be the most detailed and the most specific to your situation here. But that's another major consideration here and potential flaw of what that money could have done had it been able to provide both protection and generate returns. And so again, that is the bread and butter of the conversation that we would have with an individual making this analysis.
Yeah, beyond what you said, part of that analysis when you're choosing whether to do this or not is what kind of assets do you have? If you're somebody that has, like, let's say you're doing the option trading like we do, and you've built a multi seven figure portfolio, that changes the metric on whether you want to dump a couple $100 into this maybe benefit.
Yeah.
So everything, you have to look at the entire picture before you just say yes to this or no to this. There's a lot of variables that need to come into it. But I think something that's near and dear to our hearts as fathers and people that are thinking generationally is the fact that this benefit dies with your spouse. Now,
Yeah.
we're not talking about it on this. There is a kids option where up until a certain age, if you die before, while your kids are young, they can receive the benefit and not your spouse until I can't remember the age off the top of my head. Whatever it is, something in the early 20s with college or not college. That's fuzzy to me. I didn't really study that too hard, but that benefit exists, but only while they're young. The the 99% solution when it comes to SBP is they're trying to take care of your wife, and that's what most service members are doing. So when she or he dies, it's over. Your kids get nothing. There's zero inheritance. There's no generational value. There's no asset to transfer. For me, that's a problem. But not everybody thinks that way. And if you don't care about that, you don't have kids, then that doesn't matter. It's not a problem.
Yeah.
And
Yeah.
I
Absolutely.
think
We
the
want to focus
fourth
on that.
major issue is that you are locked into this. So after you retire, there's a window. It's at just after 2 years. So from 25 to 36 months, basically between the second and third year, that you can opt out of it. If you miss that window or something changes in the decision matrix, once you get past that 3 year mark or that 2 to 3 year mark, you're done. Like, you're paying it for 30 years. There's no more options. Now, it does stop paying if your wife predeceases you. So that the payments end immediately, or that month. But you can't change your mind in 10 years and say, this was a bad idea, or I've built a real estate empire now, or I've built a lot in the market and I don't really need this anymore. Too bad. So I don't
Yeah.
like the fact that you're locked in. You have something we talk about you're lacking: control.
Yeah.
For me,
Yeah, for
that's a
sure.
problem.
And maybe those first few years, because when you do the analysis here, like we said, the earlier you die, the more value there is here. And so those first few years, if you have decided and you're within that window still, it might be a decent call, because the returns in that situation, if you were to die during those 3 years, are really large, because the longer she
Yeah.
lives at that point, you've paid very little in costs, but you've generated a pretty substantial ongoing annuity plan effectively for her. And so that could really be a time that's the most exposed that you are in those early years.
Yeah,
But
and there's analysis there, like family health history, service related injuries that or service related. Maybe you took too many poisonous jabs and you have some kind of autoimmune disorder, and you're looking at
mhm,
dying young. Like, you have to think about so many more variables than check yes or no.
right. Yeah,
Yeah,
if you're triple boosted or whatever, you probably this is not a bad play for you.
it might not be a
But we
bad
can
play, and I'm
probably
not. I'm even
yeah,
saying that like that's gonna. We'll get to the conclusion, but sometimes these make sense. So let's talk about like when it actually pays off. Remember the numbers. I
yeah.
can flash that screen again here real quick. Um,
300 and change a month got you your wife about 3,000 a year. Sorry, 3,000 a month. if you died early, that being 55% of your $5,500 monthly pension.
Yeah, so we pay
So
one hundred
yeah,
and
350
twenty-eight
a month.
thousand dollars approximately. If I live, if I live the full 30 years, I'm going to pay about that much amount. That much. She's going to receive this. Now, there are cost of living adjustments to this, but I don't know what those are going to be. So we just stuck with this with no inflation. Just you just have to work with that. We can't figure out every single metric forever. But the nice thing is she only has to receive that for 3.5 years for it to actually be to get all the money back that I put in. So that's not a
Mhm.
terrible outcome. As long as she lives 3-4 years, she's going to get every dollar put in. If she lives 30 years, she's going to get $1,089,000 in total benefits. If she lives
And that's
40
assuming that
years,
you pay. That's assuming that
yeah,
you live the full. Like you, if you the
exactly.
earlier you die, the sooner that break even happens for her.
Absolutely. Yeah, that could come down to 2 years, 1 year. It could be a month if I die right away. So yeah, like you said in the beginning, the closer we get to that number on the front end, the better benefit this is. But this is assuming I live and pay for this for 30 years. If she were to live 40 more years, like maybe she's a lot younger than you. Another thing to think about. If you've married somebody that's 15 years, 20 years younger than you, like they're probably going to outlive you by a lot. Might be worth it.
Hmm.
Um, but yeah, so if she lived 40 years, that ends up being like 1.45 million. So the longer she lives, the better that is. And but
Hmm.
again, it assumes you die first. And there's another assumption there. There's another rule about this actually. It assumes
Hmm.
she doesn't remarry before the age of 55. I actually have a friend in this situation, uh, who is engaged to somebody, but she's not 55 and receives this. So the 55-year-old thing, like you can't remarry or this cuts off completely. Now, if that person divorces before they're 55, it resumes. So really weird rules around that. They just can't be married to another person and receive this at the same time. They can get married, they can get divorced, pick it back up. And if they get married at age 56, they can continue receiving it.
Yeah. So your friend effectively has to like can't can't get remarried if she wants this payment to continue,
Correct.
which is
And yeah, and with multiple young children, like it honestly probably doesn't make a lot of sense.
yeah.
Which is a shame. Like so the state, the government is saying like, no, you're going to remain alone. You're going to remain a widow if you want to receive this benefit for your deceased spouse.
Yeah.
Ridiculous
It's
construct there, but that's a whole nother discussion. So there's something called DIC that stands for dependency and indemnity compensation. This is an important part that we need to talk about because it changed just 3 years ago. That's a VA benefit. It's approximately $600 a month. So
or
if
1,600.
1600, what did I say?
600.
Oh, $1,600 a month. Correct.
1,600 a month.
1,600 a month. Thank you. So that is a VA benefit. If the VA determines that your death is related to a service-related injury or problem, or you've received 100% VA compensation for 10 years, your spouse is entitled to this $1,600 a month, which is 19,200 a year. Prior to January 1st, 2023, those two things offset themselves. So survivor benefit plan was reduced directly by that DIC, by this VA benefit. So they could only still get the maximum survivor benefit plan. It just so you paid more money into it, they got less from that particular benefit if
Right.
they also got the DIC. Well, as of 3 years ago, which nobody talks about, they're allowed to receive both. So that changes a lot. That's adding 19,200 to their annual annuity. So now instead of 36,300, what's that go up to? 55,500, I think it is. Doing some quick
Yeah.
mental math there.
Yeah. So you're
Yeah.
basically recovering. Essentially, you're in that situation. Using you as an O5, you were getting 5,500 a month. Your wife got 3,000 after that offset. We're not quite all the way back up to 55 with there. We're about 45, but we're recovering some of that 45% haircut that you take. So the family is, that is certainly a from a policy decision or from our perspective as someone considering this is certainly a big thing in the plus column that you're no longer going to forfeit this right that you might have. And so we can debate that, like a lot of the policies and stuff. If I was a lawmaker, I'd get rid of military pensions and VA disability entirely. But then, as long as it exists, I'm going to collect a VA, the VA disability I qualify for. Had I made it to 20, I would get the pension, right? And so, like, as long as the system exists as it is, we don't really need to do too much discussion of the merit of these policies. But this one we can categorically put into the plus column for
Yes,
us
big time.
trying to make a decision.
It's a totally different value proposition here. I mean, it's that comes out to, like, on those numbers with our example here, the 55, or I'm sorry, the 3,025 a month on SBP, and then add to that the 1,600. That's over a 50% increase in her,
Mm-hmm.
what would be her monthly annuity. So totally different, and you really need to make a good decision there. So you really got to think about how you're looking at this, and what is the likelihood of you having that. If you have 100% and you're going to have 100% VA disability, like, lock that in. That's probably pretty good. If you have a high likelihood, let's say combat veteran, you've had major problems, toxic exposures, different things that you can easily say there's a high likelihood I'll have a service related death. It's definitely something to think about. If you were a pencil pusher who never deployed and have no actual disabilities, then and you have a very low probability of having your death related to your time in the service, like, probably not something you should build into the decision matrix.
All right, let me just ask this, because this DIC element is new to me. Because again, SBP fell off my radar as far as really personally tracking it when I no longer qualified for it. And so this DIC. So if someone's listening, in my situation, they didn't make it to 20, they don't have the pension. So SBP isn't a conversation they're ever going to be having themselves, but they do have 100% VA disability. And they live for 10 years, and 12 years in, let's say they die after collecting 12 years of 100% VA disability. Are you saying that that person automatically qualifies for DIC? Like, their spouse is going to get 1,600 a month just because, independent of the SBP conversation, they don't have a pension, they don't have SBP, but if they live for 10 plus years, they're locking in an annuity for their spouse of $1,600 a month just by merit of that VA claim being 100%. Is that
Correct.
what
As
the
long
DIC
as you
is?
maintain that 100% rating for the whole time, the whole duration of 10 years.
Interesting.
Yeah. So
Did not know
so
that.
this exists separate, but the problem was, and there was a whole bunch of lobbying around this, that finally the laws got passed in 22, effective January 1st, 2023. That it used to, like, the government was like, oh, well, if they're also getting this, they're not going to get as much of this. And they're two separate things because you can get one without the other. And of
Right.
course, the government just screwed the pooch on
Yeah.
that one for a long time. And there was like a phase in period for a couple years. But yeah, now you can get
Absurd
100% of both.
policies in general, but they exist, and so you should understand them and you should optimize within them. And on that note, if you are a veteran with a disability claim that's less than 100% and you haven't tried to get it increased, there are services that will do that for you, and we know people who have used them effectively to go from either 0 to 100% on their first try, or from whatever percent they got themselves to 100%. And so this is another compelling reason, not just for while you're alive, but you should look into this, get yourself to 100, because that's a great value right there. And these companies, most of them, if they don't get you that increase, you don't pay them. So reach out to us and we can put you in contact with people who have done this, or companies that do this, to where you get a free look effectively. Can we get you to 100? And you'll only pay us if we do get you an increase. And ideally you get to 100. So you start your timer on this 10 years towards this DIC, because that's a very powerful annuity right there. And when we think about, for instance, if you have 100% disability, say 2 kids, it's about $4,200 a month tax free. If you put that into a calculator, an annuity calculator, and said how long, like how much would you need to put into a single pay annuity? How much of a chunk of capital would you need to turn into a money printer that could generate $4,200 a month of tax-free income for life at your current age? You'd probably need about $2.5 million paid to an insurance company in the form of a single pay annuity to generate that income for life. And so if you have that pension, or sorry, if you have that 100% disability, it's as if you had 2.5 million to invest, and you put that into a cash flow engine that spits out cash flow for you for life. that's about replace. That's as if you had an asset worth $2.5 million working for you, printing out money, right? That's how you think about a single pay annuity. Is this is a printer? This is an engine. I basically bought an engine that generates cash flow. In this case, you have a $2.5 million Rolls Royce engine that's giving you this 100% VA disability tax free for life. And so in that example, about a third of that is the $1,600 a month. So you could say that for, if it's 2.5 million, then about a third of that is how much this engine that you're creating for your wife is worth if you live 10 years with a VA disability of 100%. So get that disability, get that $2.5 million working for you, generating cash flow. And then when you die, the engine doesn't just go away. In this example with the VA disability, the engine just reduces in size by about 2/3, but you still have an engine generating cash flow for your spouse. So that's an enormous plug for the value of doing whatever you can to get to 100% disability.
And it's funny how I used to be like opposed to that until I realized how the VA more or less allots a 100% disability to every service member ahead of time, and what you don't get just goes somewhere in the government
Yep.
throat, and they blow it. So I feel like I feel now that I've learned that it is always better in your hands than the government's hands, because we know at $38 trillion in debt, they will not allocate the money well,
Yeah, they're
and you can
currently just
actually benefit your
hemorrhaging
family.
blood and treasure. As of the last week or two, they're just going to start blowing blood and treasure on another pointless war. And so, um, you know, take it out of their
Yeah,
hands, put it in your family's hands, put it in your family's economy, and generate cash flow engines for yourself. That's what we're trying to do overall with our financial strategy. And if you can have someone supplement that, i.e., in this case, the VA, or the
take it.
government via your pension, like the system exists, as ridiculous as it is. So just optimize within it. That's always should be our goal.
I agree. All right, so let's talk like really quick. This is a infinite banking podcast, so we don't have to hammer all these homes, but let's just kind of talk about the alternative now. So we've given the two scenarios. We've given straight SBP. We've given SBP with the DIC VA benefit survivor plan, but we haven't talked about whole life yet. So some
Mhm.
differences, as we know, the fundamental differences is with SBP, like we've said it multiple times, you pay for 30 years, you get no cash value. Your spouse gets money after you die. It ends with her, and if she dies first, it just ends. You lost that money, so you have zero access to that cash once again your entire life. So Hans, compared to whole life, a quick bulleted overview of paying money. And of course, I do want to caveat before you talk about this that in order to make this system work, you're going to be paying more premium than you would for survivor benefit plan. Like we're going to build a system, a banking system with much higher premiums in these examples. So it's not an
Yeah.
apples to apples as far as the input into SPP or the input into whole life. But run with what's different there.
Yeah, and it gets back to how we frame premium within the IBC conversation. When I look at the premium that I'm paying, it's not an expense. Like if I had survivor benefit plan and I'm looking at here's my cash flow and here's an expense, I'm purchasing something that is an out of pocket expense that generates while I'm alive no income, no value, right? It is just paying, it's a pure cost of insurance. When we're talking about a whole life policy structured the way that we do, none of those dollars that we're paying into our premium are just an expense for an if or like a binary scenario, like a term policy, which is just do you die during the term or not. Every dollar that goes into my whole life policy is generating value now and in the future, guaranteed. And so I don't look at this as an expense. So I don't mind the fact that I'm paying more than I would be to survivor benefit plan to recreate the same protection, because in doing so, I'm generating value now. And so let's say whatever the premium amount is that we're talking about here, if 80% of it right off the bat is generating cash value that I can use now, and then I can start leveraging that via the mechanism of the policy loan, I can put that savings to work without depleting it, as in, doesn't mean it's fully accessible because it's leveraged, it's collateralized via policy loan, but it is still growing and compounding as if it's untouched because it technically is untouched. And so we're putting that death benefit in place and effectively borrowing from that future death benefit by using a policy loan. And without going into all the benefits of the policy loan, it is the most powerful lending mechanism we can possibly access, and it's something that we should understand. And it's not as if you know how to use a policy loan, then you understand why it's not just that, well, here's money going into a policy and here's money going towards SBP, and this is our two comparisons. Because when I think about what I'm doing with my cash value, I'm generating well over 100% return on the interest I'm accumulating. And anybody who's gone through an intro call with me understands that. We've walked through the policy loan. We also have an article on the blog walking through the mechanics of the policy loan. We have several podcast episodes on it. But if you don't understand how to use a policy loan, just take my word for it now, and we can discuss it graphically and walk through it later. That it's not just it's the fact that I'm making 100% return on my cost of capital is very easily provable. And so if that's the case, then I know that it's beyond just getting, instead of SBP, I'm instead paying towards a policy, but then I use that policy to then springboard into whether it's low stress options, crypto, whatever my investment strategy is. I'm facilitating investment in a manner to grow these dollars without depleting my principal, because I'm borrowing against that future death benefit. So I don't know how deep you want to go into policy loans, but it's like, the summary for me is, don't just think of this as both of these things are sunk costs. Which sunk cost is less? That's not accurate. I would much rather pay a $10,000 premium than, whatever the $300 a month is, right? The $3,600 that I'm paying towards, survivor benefit plan. That $3,600 is a sunk cost, where my $10,000 annual premium structured for IBC, zero of that is a sunk cost, especially once we get past this initial capitalization period. Again, that might not make sense if you've never studied an IBC policy, you've never walked through how to use it with us, but keep in mind that it's not an apples to apples comparison. And it can't be, really. And so we would need a lot more analysis to really get an apples to apples here. But if you have time to build this IBC system before you get to the decision of, do I sign up for SBP or no, you can make this conversation a moot point. There's no comparison. But if you're at that conversation, which is where we're starting right now, this 42-year-old who has to make this decision now, well, then we really need to get some momentum going with this policy. And so that's a little bit of a harder decision, where we have to get a lot more granular. If you're younger, if you're still in the military, if you're 10 years in, you got time till retirement, you can generate something now and schedule with us if you want to have that conversation. You will blow the SBP out of the water, guaranteed. But you just need to understand how that works.
You will. So I'm going to share my screen here again. Now, for compliance purposes, I didn't want to share the actual illustration, so I transcribed everything. But we got all the important numbers here. So what I said is, I took that 42-year-old O5, assuming he's going to remain in the workforce. He or she is going to remain in the workforce and can easily afford this with their pension, plus their new salary, their new income, their new business, whatever they're doing. So they're paying a $20,000 annual premium. I only broke this down on one. Assume, like, for the next couple examples, it's something similar. So this is a base premium of $4,186. I put the waiver premium on here, which Hans mentioned earlier. It's a little bit of a sunk cost that provides a phenomenal benefit that we think is well worth it. But that's $351 a year combined for the whole life and the term. There's a 30-year term premium on this, and that actually takes them to age 72, which is important, because the longer that term lasts, the more expensive it is. And in this case, it was still only $340 a year. So really inexpensive. I think it was like 100,000 or something. It's not. I didn't need a big term for this. And then the PUA, the portion of the PUA is 15,122 right here. So this person would have actually been capable of paying another 2,000 if they wanted to, if they had the cash flow to do it, and that would generate even better cash value and better death benefit. But so if we look at this, here's some random breakdowns I put. And the reason I stopped at 35 is, I said the average lifespan in America for a male is 76 and a half. So I'm killing this officer at 77 and saying that's what they could deliver. Interestingly enough, the 30-year mark is also marked here. So this is the point at which they would stop paying survivor benefit plan. So if they lived to 72, 30 years into the policy, those payments to survivor benefit plan would stop. they would have paid the total 128,700. All right, so let's look at this. Like Hans was saying, you have access to this column, I should say, the entire time for all the things you do, whether that's investments, whether that's purchases, your daughter's wedding, college, buying a home, whatever you spend money on that you finance now, you can access this through the policy loan provision. So this isn't locked away from you your entire life. And these numbers, as you can see, climb substantially by paying that premium. So at 30, you at that point in your life have access to $1.2 million in cash value. And if you would die right then, you're delivering a $1.75 million benefit. Pretty substantial. Now, if you died here, your wife was better with the survivor benefit plan. Fact, period. She would have received more net income through her life if she lives a long time. Again, all those
If
things
she
come
lives,
in.
yeah.
So it's a time game here, and you really need to think about all those things. But let's just look at the next example real quick to show what Hans was just saying. Start young. I took a 10-year officer, assuming they started at age 22, they're halfway through their career, they know they're going to commit, and they're going to have to make this decision on the survivor benefit plan in 10, 12, 13 years whenever they retire. So I lowered the premium a little bit, just by 2,000. This is a substantial premium for somebody at 32 based on their rank and based on their income. So it can be done. I know it can be done because we've done it, but taking $18,000 a year. So look at their cash value. Now look at those same things. Now remember, this person would be 40. They would have paid 40 years into this. So at that mark, they have 1.9 million, and the death point, age 77, they have 2.4 million in cash value compared to the officer who started at retirement at 42. They have an additional about $800,000 in cash value just by starting 10 years sooner. And if they both died at age 77, they're going to deliver an additional $1 million to their family. That's key here. This is super important because with a survivor benefit plan alone, it ends with your spouse. And I'm constantly thinking about how can I make my family stronger? How can I make sure that my grandkids are starting off on a financial solid ground? Anything to add in
Yeah.
those two, Hans?
No, it's just I like to think through this conversation when I'm talking about insurance, not the SPP, but just in general. I think if you think of yourself as yourself and your family, then every dollar that you put into your IBC policy is going to multiply many times over to your family one day guaranteed. It's the early few years of this where SPP might be more optimal. That period of time is if you're comparing to your policy, those dollars, that's assuming that you die in those early years. And so you might have been better off for a year or two. It's really hard to imagine that after a few years there's a scenario where SPP was the better call if you live beyond, say, 3 years. And we're not going to run every single scenario, but
No, we
really
can't.
the SPP has value in those first couple of years when the IBC policy is really getting off the ground. But again, if you die during those 3 years, it multiplies itself many times over into a death benefit. Which again, like we could just kind of dive down the technicality rabbit holes of comparison here forever. But if you're in that 3 year window where you opted into it, but you still have the time to get out, you probably could have covered the most risky years that you had where the SPP really shines. But the time to build this out is, again, like for this 32-year-old, it's incomparable what you can do with this.
Yeah.
And you don't even really have a decision to make at that point. It's really only if you're coming up on retirement and having to make this that's even in the cards.
And I think one of the keys here, just to reiterate what Hans always already talked on, is the cash value. As
Yeah.
opposed to anything else, you have access to this money. These are the cumulative amounts. So at 20 years, you have access to 552,000. So
Right.
maybe you want to move, maybe you want to buy a lake house. Whatever you need access to money for, you have it via that policy loan provision. So you've built a real asset over time. And that cannot be ignored when you're thinking about, you can't think of this in a vacuum and to think about all the benefits of this asset compared to just paying the SBP premium. Or maybe you do both, which we'll look at here. So to draw the full comparisons, and again, we can't look at every single possibility. So I'm just going to say you died at 72, right? Excuse me, at the exact same point when you stopped paying the premiums for a survivor benefit plan. I made your wife a little bit younger so she could collect this for a good period of time. So she's 65 when you die at 72, and she lives to be 90. So if you just did the survivor benefit plan and you don't have this DIC, this VA benefit, you don't have you don't have the 100% benefit, or you don't have a service related death. She's going to get $36,300 per year. There's no COLA adjustments here, just keeping the numbers basic. So you've paid $128,700. She, in those 30 years, is going to receive $907,500. This is a key here. I did them out of order, but there's no inheritance effect. That matters a lot to me. The net total to your family, to her, and if they're still young kids or just to her, is $778,000. So if you have that benefit, if you have the VA benefit, and she's going to receive 55,500, you paid the same amount. This is what she receives in 30 years. Pretty good. So she nets $1,259,000 rounded. And finally, for that, if you started the whole life policy, I only showed the 42-year-old, he would have paid $597,543. This is if he elected not to do these as well. He said, I'm only doing whole life and I'm not doing any survivor benefit plan. So his family would receive 1.75 million upon his death. For a net total benefit to the family, it's subtracting the premiums paid, even though we do understand that those premiums have been available to you the whole time. They've never left your life. But the net benefit, assuming there's no policy loans and she gets the entire death benefit, is 1.152 million. So you can see that it's not in a vacuum, because in this exact case, if everything worked out perfect, your family is going to receive more money. Your wife is going to receive more money doing this.
Yeah.
And so, like, yeah, and you probably thought that I was just going to say whole life wins. Of course, if your wife lives, doesn't live much longer, she's going to leave whatever's left of this behind, which I think is a huge perk. Which to me, because this difference isn't enough, this $100,000, to me, the legacy matters more. So that's where, in my personal situation, it matters.
That is isolating it as if the only thing you're doing with this policy is just letting it grow. When I walk through what I'm doing with my policy, I show on the line for line on the illustration. In year 1, I invested in the real estate syndicate. In year 2, I got my first rental property. In year 3, I got rental properties 2 and 3. And in year 4, I invested in low stress options. So I have 5 sources of income generated from that column that we saw there. And the income generated from those policy loans is more than double what the interest those loans are accumulating. And so that's about that on every dollar that I'm paying in interest to the company in order to use those dollars, I'm generating more than $1 of net profit. So I'm making at least 2 from these investment returns, while also, the rental properties are great for taxes. So I'm getting a lot more outside of this. And so to me, if you're doing anything at all, even if you just take a policy loan to, invest in a very basic, simple, index fund or something, you're going to blow out that option there, where in a vacuum, if you did nothing, the survivor benefit plan would have been better if everything worked out. But again, the good thing is, when we're talking about the whole life, we're removing all of the ifs. We're not saying if you live this long. Like all of these considerations, the ifs are removed. When we're talking about if we pick the perfect optimal plan for SBP, there is a way that it is optimal. If this, if this, if this, if this. We have to make a lot of assumptions to get to that optimal point where it can outshine, or it can do better than just a whole life policy with nothing being done as far as leveraging the cash value. So there is a narrow path, a flow chart where you can get to a better outcome with SBP. You die early, or if, and you live a long time, all of these ifs, and your wife lives much longer, then there is a scenario where it could also outperform. But philosophically, we don't like the ifs.
Yeah,
We are such big fans of the product and the asset that we use because we don't want ifs in our financial strategy. And when we're talking about SBP, we're inherently talking about the protection. We're talking about continuing income beyond our life, which is exactly the conversation we have when we have the whole life, the human life value discussion. What are you worth? And how do we ensure that if you don't wake up tomorrow, your income continues and your family gets the benefit of what you would have earned had you been here to earn it? So there's a lot of overlapping conversations when we're having an SBP conversation. It resonates. It sounds a lot like the conversations we have. It's just there's so many more ifs that it's kind of like it's overwhelming to really try to do an apples to apples comparison because you have to make so
it
many
is.
assumptions to make the SBP work. And again, if we knew you're going to die in 2 years, SBP is good. And also, you know what? If we knew you were going to die in 2 years, we wouldn't put you in a whole life policy. We would get you term, right? Because
That's
if we
right.
knew, these risks that we're insuring against had some certainty to them, you would be better served by paying the lowest premium possible because that is how we're going to maximize. So like, yeah, like if we had perfect information, term would be better than whole life for people that we know are going to die during the term. And so we don't deal with all these ifs, and because we don't have perfect information, we have to optimize within the information we have. And we think we can do that. For most people, it would make a lot more sense to do the whole life, particularly the younger you are. Even if you have 2-3 years to get a jump on this, if you're at 17 years and you have 2 or 3 years till retirement, you can get a jump on the whole life and make it to where the discussion doesn't even matter. It's
Yeah.
just if you're starting now where you really might have a harder decision to make.
Yeah. And so just to like look at the absolute nightmare scenario possibility of this is that you live the full 30 years, you pay the full $128,000 in premium for SBP, your wife dies before you got nothing. You don't get a refund on that, you're just out. However, as opposed to if you just did whole life, if you live and pay those premiums for 300 or 30 years, you've probably paid, I don't know what it comes out to, 500 some $1,000 in total premiums. Your wife dies, you still have the asset, you still have the cash, you still have the death benefit, you still have your retirement.
Yeah.
So all you're going to do is change the beneficiaries if you have children or to whomever you want to change it to. So the asset lives on, the asset still benefits you, and it gets to pay out. So that's like the absolute worst case scenario. Where
Yeah.
SBP wins is if you die, let's say in those first couple years, and you just haven't built it out, and you're only doing one or the other. Um, you're going to pay a lot more in premiums. They're going to get a lot less in death benefit. And that is also drawing the assumption that your spouse lives a really long time after you died young.
Mm-hmm.
And if she continues to live a long time, she's going to win with the SBP, especially if you have the VA benefit on top of it. But I still think that the hybrid approach matters. And when I'm thinking about my family, me personally, I have a few $1 million already in whole life insurance and a lot more term that's going to get converted. So I know that there's going to be multi millions in whole life because I started this in my 30s long before my career was coming to a close. But you know what? I still might choose a low percentage. I still might do like 25%. That's what people don't realize is you don't have to do the maximum SBP. I still might even add into that in case I have, I might get some kind of service related um, VA benefit. I don't know that, but under that probability, why not for a short amount do a 25% and it'll only cost me 100 some dollars a month. It might be worth it. And matter of fact, I might just do that just to give her a guaranteed annuity as well.
Yeah.
So I might take the hybrid approach. I haven't totally decided yet. I have plenty of whole life that it doesn't matter, but helps her continue with her premiums, which she won't have a problem with. Depends if my wife learns to trade, because I will push that, and it's even in a letter, like
Yeah.
learn to do this. So I think
Yeah.
that might be my compromise is do like 25% as a hedge, even though I have
Yeah.
enough death benefit. But the problem is if my term isn't all converted, I have plenty of terms. So actually, because income has gone up, I'm not at human life value anymore, even though we always talk about that, but that's a constantly changing number. So I no longer have enough insurance for human life value. I need to add some. So when I think of that, like she's still short of what my human life value was. So another decision, like, can she continue the lifestyle? Can my kids continue the lifestyle without me here? They can do pretty
Yeah.
well because I'm not a consumer anymore. So I probably don't need 100% human life value for their lives to stay the same. But adding in a little annuity might not hurt. Little guaranteed income.
Hmm.
I don't know.
Yeah.
It's yeah, for nobody, it's not completely clear cut, and it's pretty cheap annuity insurance um, for her to get, 1,000, 1,200 bucks a month.
Yeah. There's so much, again, like I guess the summary of this, a little frustrating, but the summary is it depends. But really, it only really depends if you're very close to that point. Again, the main highlight, if you are a young officer, if you are someone who has a few years to get a head start on this, you can put yourself in a situation where you don't really need to think about this. This becomes, like you said, maybe I'll throw a quarter of it towards this just as a nice little annuity, but it's not like we're not making this tough decision here of, how do I ensure all of these what ifs? Like, you can really get a jump on this once you understand how to structure a policy and get to the point where you don't this is not something that's even on your radar. And that's a good point to be at. Like, having to make this decision, I'd rather not have to make this decision because I've already got this optimized. And so,
Yeah,
again, it
I,
always
I think
depends. But
the answer is it depends. But I think if I were to like give you check boxes, what I might say is like, you have a high probability of getting that VA benefit, and you don't
yeah,
have a lot of cash flow. You have no whole life right now. Probably take it. Because if you have that service related injury and you're more likely to die young looking at that, I would say probably take it.
hmm,
If you have, 10 years to retirement, and what I might end up actually doing is just rejecting it all because I have plenty of whole life. I'd start the whole life and not even worry about it because you'll see that in 10 years, you'll be like, I'm not even concerned. I'd probably elect
yeah,
for whole life instead of survivor benefit plan. If you also have the DIC coverage, you might elect to take a little portion of it. I don't know. And for most people, like if you're inside that 5 year mark, maybe do a hybrid approach like I'm talking about. You can probably afford both. And and I guess the fourth metric there that I didn't think about is if you have absolutely terrible cash flow habits and you simply can't afford whole life insurance because you spend every dollar you make and
hmm,
Parkinson's law rules your life, take the coverage
yeah,
because if you can't afford it, you can't afford it. Don't leave your spouse high and dry. I'd rather you leave her something than nothing. And if it's
yeah,
forced out of your paycheck and you can't do anything about it, you're at least benefiting them in some way. So if you're terrible with your cash, 100% take survivor benefit plan.
yeah. If you need Dave Ramsey's financial advice, you probably should stick with the VGLI and SPP. Really not optimizing there, but if that's you, know your strengths, know where your weaknesses are, and and be realistic with your where your financial IQ is. And if you need Dave Ramsey, then you probably need SPP. You need
Yeah.
that forced habit to ensure that protection's there, because if you would just spend that money otherwise, then when the worst happens, and we all live until we don't know when that day's coming. And so if you need to be, the same way that if you need that money taken out of your paycheck before you even see it and put towards retirement, just in a long-term qualified plan, that's better for you if you would spend that money and get nothing out of it besides short-term spending pleasure. So know yourself. But if you want to have a conversation and talk through your specifics, and if you want to learn more about what this other path is, if you're military and you're not really coming up on this decision anytime soon, but we keep talking about this other path of how you could kind of do this hybrid approach or optimize. Like, if that's uncertain to you, then that's something that you can schedule and we can talk through, so you actually understand when I was talking about policy loans, leveraging all this, how to use this, keep the principal in place. If that doesn't really resonate with you yet, then we can have a conversation and see what we can set up now so that we can preclude this from being a conversation you really need to worry about in the future.
Yeah. So I hope the point is that it's just not the black and white decision. I hope what you've taken from this is it's not the black and white decision that they're going to give you when you go to retire of do you want full SBP or none? That's pretty much the checkbox you get. There
Yeah.
are so many different factors here. It depends on your age, your probability to get that DIC compensation. It depends on your family situation, your values, your goals going forward. There are so many different variables here that it's not a straight up decision. Spend some time thinking about it. Call us and talk through it. I'm just about through like a 50-page or so white paper that I've been putting together. It's not quite done. Hopefully, by the time this comes out, I'll have it finished, and it will be linked in the show notes if you want to grab that and kind of read through. It'll have a lot more examples than we were able to talk through in 1 hour. It'll have a lot more information about the different aspects of SVP, so it'll be pretty detailed. But yeah, whatever you do, whether you choose just whole life or you choose a hybrid approach, just make sure you're making an informed decision. And I think that's where many people fail right now.
Yep. All right. Well, it's good. It's good. Hopefully most of our listeners get something out of that.
Cool. All right, brother.
All right. Cheers. Talk to you all next week.
Cheers, man. Talk to you soon. Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.